Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this episode, I talk with Amrit David, Managing Director at Barclays, for a final look at M&A in 2022. We discuss several deals completed with assistance from Barclays this year and what trends they show. We talk macroeconomic challenges that could affect M&A going forward, including investor behavior, and we get into continued consolidation and more. Give it a listen. Amrit, it's so great to have you here with me again. I always love our conversations about M&A and excited to jump back into another one. So welcome.
Thank you, Sandy. It's great to be here. It's great to be coming out of the pandemic, and it's great to have the opportunity to sit down and chat through this. There's been a lot going on in the market.
Yes, a lot going on. So let's get going. I understand that your firm, Barclays, recently handled a couple transactions that we know of, the Partners Group investment in Foundation Risk Partners, as well as Truist's acquisition of Benefit Mall. So is this true? And if so, do you have any interesting takeaways for us?
Yeah, we did, Sandy. Thank you for that. Look, I would start by congratulating both of those management teams and those sponsors and candidly those buyers too for two fantastic assets. As you know, in M&A, and I'm sure as you've picked up with others, these were long journeys over the course of a couple of years to kind of get us to these kind of outcomes. And we're very happy with both of them. Look, what I'd tell you, and I think we're going to talk about this a bit more, is there a continuation of two broader themes that we've consistently talked about. One is private equity's continued interest in the sector, especially on the retail side, but also growing. Mm-hmm. We expect to see more of that. So we'll talk about that, I'm sure. And on the other side, it's interesting, a strategic transaction where Truist has been a long-time consolidator of these assets and someone who sees long-term value in insurance distribution to supplement their broader business continuing to acquire. So I think that also opened the door for many people to think about strategic conversations, which we're seeing as well.
Mm-hmm. Yes, definitely a couple topics that we're going to dive further into. But I understand the Foundation Risk Partners transaction had some impressive stats around it. Can you share some of those?
Yes, look, it certainly did. I'm probably not in a spot to talk a lot about the numbers. Mm-hmm. That's not public information, but what I can tell you, which I think is relevant, is why that really resonated for folks and for buyers in the community. I think first of all, we spent a lot of time with the company and with their sponsors and others setting the stage and creating an environment for the management team to tell their story. I think that is super important. And secondly, it was the nature of that story. It was a very different story than others had told in the past. It was one of integration, technology, operations, culture, and that really resonated with many of the folks around the ecosystem here, especially new folks looking to enter the ecosystem. And by that, I mean the private equity guys. Mm-hmm. And they looked at a number of platforms in the past, and this looked and felt very different than just someone aggregating. Obviously, aggregating is what they do, but there are other elements to it, which I think have become more and more important, and maybe with this macro backdrop will be more important. And then thirdly, I think there's a lot of teams out there, but this was a team that really shone quite impressively in the context of what they've been able to achieve over 4 years. So while I can't get into all the numbers, I think the why is probably more important to be candid about it, about how they got there and what they did.
So you just mentioned the macroeconomic sort of conditions that we're working with here. Let's go into those a little bit more. Inflation, interest rates, the broader market. What are your thoughts about what's happening here and how this is affecting our space?
Yeah, look, in reality, I would argue that we're in the fall of 2022 here, there is a fair amount uncertainty in the macro backdrop.
Yeah.
Look, we're coming out of a global pandemic, and that resulted in a couple different things. There was a incredible increase in the money supply with checks written to people, government spending. Now, all of that was, there was politics that drove a lot of it and justifications for a lot of it, but you had just a tremendous increase in the money supply. You had a somewhat material withdrawal of labor, with folks either choosing not to work or deciding it wasn't worth it. So you had this kind of reduction in the labor force. And then I think there's a third trend going on, a bit of a longer term trend, which is the onshoring of production, which we for many years had moved to places like, China, India, Southeast Asia. And, the pandemic brought home a lot of the risks of doing that for folks. And onshoring that labor and that production is a lot more expensive than offshoring it, because that was the drive.
Right.
And in my view, you put increased money supply, you put a reduced labor force, and you put onshoring of production all together. It's no surprise that you face real inflationary pressures in the economy. And the Federal Reserve has a mandate to maintain price stability. And I don't blame them for what they're doing. They actually need to be doing what they're doing given the mandate. And it is a consequence of the dynamics we went through over the last couple of years. Let's just hope it's all managed in a way that so that we have, the proverbial soft landing as opposed to the hard landing.
Yeah.
But we are going to be in this environment, I think, for at least a few more months here, and some way into 23.
So how do you think this will affect the brokerage buyer marketplace, both for large and smaller deals?
So it's in my view going to be a little mixed. I think for the larger, platforms or larger businesses that are maybe already sponsor owned, you have quite sophisticated capital partners for these firms. And they're aware of the backdrop, and they're monitoring their companies and the situation quite closely. And I think they're being more and more conscious of what they own, but they're also being much more conscious of where they deploy capital and their portfolio companies deploy capital. Because like I said, you hope we get a soft landing. We hope it kind of works out well, but they're going to be cautious, and we've seen that more and more in large processes, let me call it, where the typical XYZ private equity guys are just more cautious. So you have that dynamic. On the smaller tuck-in side, maybe some of the tuck-ins that those guys do or the likes, I think it's starting to emerge a more cautious environment. Now, Q1 was slow for M&A this year. I know you've done a lot of that, and you've seen a lot of that, and it's picked back up this year, and looks like we're going to kind of run through the tape again a bit. But people have been using cash on balance sheet, debt, other facilities they have to fund M&A. But as those kind of run their course through, and people have to come back to the market to raise capital to do more of those tuck-ins, that higher cost is going to be much more apparent. And I think that really plays into the market to some extent in 23. So those smaller deals become, maybe less expensive, maybe the bar is higher, but I think that's something we see into the future.
So talking about private equity for a second, and one of those themes you mentioned earlier, you said you think we will see more caution out of them, potentially. Does that mean just being really more thoughtful and specific about what they're looking for in a deal, or does that mean fewer deals because they just have less to work with? And then also after that question, we've often seen a lot of over the past few years, private equity has been a big theme, as you've mentioned. Do you think this economic environment will change that going forward, the private equity dynamic within M&A?
So I don't think, I think the answer to both of those is I don't think it really changes it. But I think it does raise the bar across the board. A few folks have come to me and said, "Oh, this could be the end of it. It's Armageddon now." I'm like, "Look, you got to calm yourself down a little bit. It's far from that.
Yeah.
Look, this is still a required product for people. It's a highly stable industry. It's got great margins and great long-term growth and great free cash flow. So let's not divorce ourselves from the fundamentals of every business here." But yeah, we are in a slightly different macro environment. All of us can generally do simple bond math, which is when interest rates go up, asset values come down because I'm discounting the same cash flow by a higher number. So that's just part of math. You can't get away from that. I would argue, though, the opportunities are still plentiful, and there's still a lot to do. I still think there's plenty of folks who want, whether it be new entrants or others to consolidate. I think we'll continue to see a lot of that. But I do think the bar is higher across the board for folks to think about it, and where they're going to deploy their capital and where they choose to deploy it. Yeah.
Mm-hmm. All right, so let's talk a little bit about one of the transactions that you worked on was the sale to a consolidator, as you mentioned.
Yeah.
What are your thoughts on going forward with large consolidators? What are you seeing there?
So it's funny. You and I have been kind of debating this question for a little while over the last couple of years, and I know we specifically worked on one transaction with Alara Propel there last year. And every year I say it's progressed a little bit. And I'll say again this year, I think it has progressed a little bit more. Historically, the hurdle was high to get kind of all the stakeholders around the table to align on the economic and social issues for the merits of a transaction, right? Because I could go buy something big and it was a big integration bet to get that right, or I could keep doing what I'm doing and then that's worked out really well so far. So why take that risk? Mm-hmm. I think what's interesting, at least in my mind, to debate is, does this macroeconomic and interest rate environment at least open the door for people to have more of the conversation, right? Do they say, hey, look, it's my plan A might still be my plan A, but should I at least understand what plan maybe C could look like? And should I have a conversation or not? Should I see if there are social things that matter or what? And should I explore if in this different macro backdrop and this different interest rate environment, the economics of whatever plan C or plan D might actually be compelling? So I do think, there's more conversation. Yeah. I cannot predict anything happens because plan A and B still look very attractive for many people. But I think many senior management teams and folks are much more open and receptive and like, it's silly not to have it. There's no value in not having it.
Yeah, it's interesting to see how this moves forward in this environment specifically. As you noted, there's maybe different reasons to think about it than before.
Yeah, look, I like I said, I still think the bar is really high. The hurdle is really high, I should say. But it's not stupid to have the conversation.
Mm-hmm. All right. We've also seen a number of transactions in the MGA market. Any observations there?
Yes. Well, look, it's obviously been a much busier segment in the market in the last recent years, as opposed to before. And I think a little bit stems from, you've had a lot of capital, private equity or otherwise, that has invested in retail brokerage. And I think they see great thematics and trends within that part of the ecosystem. And they say, what are the other ways I can get exposure to that? And I think this is largely a function of that, where they say, I know this stuff. I'm good at it. I've had some history in it. What else can I do? So I think that's really had a lot of folks pretty interestingly about broadening their set of capabilities and where else they can go. So I do think we continue to see more of that.
Yeah, that really seems to be happening as you see more even other types of industry stakeholders acquiring MGAs. That
Yeah, and it's interesting, right? And then there's a whole little merry-go-round of carriers acquiring MGAs,
right.
or even, but sometimes there are teams within carriers that want to leave and then want to set up their own companies,
Yep.
and they're getting capital from people to set up their own businesses, and then they start to consolidate. So it's honestly working both ways.
All right. Also on a similar note, we do hear a lot of talk of increased interest in specialty transactions. I think we've seen their valuations go up. What are your thoughts there?
Yeah, look, similar to some of the thematics I mentioned on before. I think the consolidators, just given there's a lot of them, they're looking for ways to differentiate themselves in the market when they ultimately do something, or actually ways for them to grow candidly as well across their book of the business. So, you could have, consolidator Y or platform Y say, I have a bunch of producers in this market, and they know all these guys that own trucking companies. Like it's the perpetual example, right? But all these guys that own trucking companies, but I don't have subject matter experts. So if I could go buy someone who has a real niche and expertise and can either build programs or is smart enough to do that, you know, one, I get to differentiate my business by having something real special that has, more barriers to entry around it to protect my business and to make it look good. But two, I have the ability to kind of cross-pollinate those skills across my broader book and leverage the producers that I have that might know all these trucking guys, but will never give me business because I don't have enough of a play scale, or I don't have enough of the specific knowledge and expertise they need to do that. So it can help drive organic across my book if I can do that. So there's really a couple dynamics. Is how do I differentiate myself? How do I build more of a competitive, lasting advantage versus others I have? And does it help me from a growth perspective?
Yeah, it makes sense as you see, brokers even trying to build more expertise in certain areas and really become more consultant-like for their clients.
Yes, that's right.
All right, let's go to insurtechs. Are we seeing a sea change in the way investors are evaluating insurtechs?
Look, the insurtechs over the last couple of years have had a really rough go of it. And I think the market is looking at them very differently. I think when I've done these for you a couple of years ago, we talked about growth and we talked about customer acquisition. We talk about changing the way people interact and deal with their insurance companies. I think the meaningful decline in valuations for at least some of the public folks has really recollaborated that conversation for many. And the real focus now isn't at growth at all costs, because if you and I are industry veterans in insurance, know that growth at all cost is easy, just lose as much money as you want. That's the best way to do it in insurance. But there's a real focus now on unit economics, LTVs, customer acquisition costs, building a business that has, scalable loss ratios, and expense bases that you can grow into, and managing, honestly, your exposure to reinsurance. We haven't talked about it yet, but everything I'm hearing is one's going to look brutal.
Yes, same.
Right. And so when you put that in the context of what these challenges these businesses are facing, investors are very focused on trying to navigate that broader thematic, because capital light is great when reinsurance is cheap. Capital light is going to be difficult for some of these guys going forward.
Yeah.
But that said, look, I think there are a couple really interesting places to play in it. I like cyber. I like some small commercial stuff. I think there's real opportunities in people building long-term differentiated platforms that provide value. And then I see a lot less in my world. Maybe this is more technology focused, but on the plumbing, right? The plumbing within insurance companies and the APIs that connect, like there's a lot to be done from an efficiency perspective there.
Yes, absolutely. I think with, sort of smoothing out those different APIs and different connectors and figuring that out seems like the next place to go from that
Yeah,
side.
I think there's a tremendous amount of opportunity there, and honestly, a lot of what I'm seeing, or at least what I'm hearing in insurtech. I'm far from a tech guy, but
All right, last question for you. Looking to 2023, which is coming right around the corner, any additional thoughts on what, we can look for in brokerage M&A?
Yeah, look, I think a couple things. One I've already mentioned. I think we've seen, as I mentioned before, I think the tuck-ins will continue to be a little bit more challenging for folks. I think by that I mean buyers will be more discerning in quality of the assets that they want to acquire, and more picky there. And I think that also will ultimately then play into valuations for those businesses. So I expect to see that. And secondly, look, I think we might see something larger, something more transformational. Again, no bets on it. Those things are very uncertain, and they're low probabilities. But like I said, there's more of that conversation.
Larger, you mean in the retail space?
Yeah, I think you might see some more stuff there. But look, you have investors who are generally very patient and will do the right thing for them and their business and their shareholders when it all makes sense. But I'm focused on seeing if there's stuff there.
Yeah. Well, it's always great to hear from you. It's always insightful. We love to hear what's going on from your viewpoint. So thank you so much, and I look forward to our next chat.
Thank you, Sandy. Really appreciate it. So it's always a pleasure to connect with you and connect with your member space too.
That was Amrit David, Managing Director at Barclays. Thanks for listening. You can listen to my previous conversations with Amrit at leadersedge.com.